The risk of sentiment has gripped the investor psyche, which has spared no asset class thus far in 2022. Not just equities, but investors across most asset classes, including cryptocurrencies and metals, have seen negative returns on their investment. A massive sell-off in cryptocurrencies, for instance, wiped over $200 billion of wealth from the market in just 24 hours. While Bitcoin plunged 10%, its lowest level since December 2020. Ethereum dropped as much as 16% on Thursday, May 12. Thus far in 2022, Ethereum has cracked 45%. Meanwhile, among equities, the US indices have sunk the most as fears of steeper rate hike coupled with recession plague markets. Back home, the Indian benchmark indices seem to have fared comparatively better so far. Bond markets, on the other hand, have seen the India 10-year G-Sec yield rise from 6.01% a year ago to 7.25% now. Meanwhile, retail inflation surged to an 8-year high of 7.8% in April. Analysts say these negative returns have largely been triggered by panic selling by new investors who exited in droves in the backdrop of rising interest rates, inflation worries, and the geopolitical situation.
Across the world, a lot of new investors have come, which are basically they are all millennial. Okay. So they look for something quick gain. So as contrast to the traditional investors, if a risk comes in equity, go to gold, silver, risk, less conservative asset classes, less risky. So they are the one who used to jump gold, silver, and not equity show some risk. Now, this market is largely incrementally dominated by new investors, millennial, sitting at home or computer doing trades on their own. They want a quick returns. So even if equity goes down, they are not willing to chase silver and gold. That is the reason for silver and gold to underperform. Last 2 years, people have a very bitter experience of seeing this crypto falling 30%, 50% in 6 months. So it has become, even for the youngsters, new generation, it has become an extremely risky asset classes. It is not the cup of the tea for the young generation because of the lumpiness, illiquidity. Then fixed assets, fixed income securities, which they give only 5 to 7% return. That is also not cup of the tea. So that is why all these asset classes are not in favor. And because of the economic fundamentals with which the equity asset class is highly related, is weakening.
Analysts expect equity markets to stage a recovery in the later part of the year as these new investors make a comeback.
This is why I am bullish on the equity, because of these problems with other asset classes. Again, all these new investors, millennials, they will come back to in equity in a very big way. So right now that is also down because of the inflation, war, high price, profit booking, all that. But it will bounce back because other asset classes have these problems.
That said, the near-term texture of the overall market remains weak despite intermittent bounce backs. According to Anand James of Geojit Financial Services, there is a low probability of a breach below 15,671. Pullback rally can lead the Nifty to 16,220 and consolidation in 15,945 to 16,090 is the key. There seems a low probability of an all-out panic-driven collapse or a breach below 15,671. The reaction rally that could unfold thereof has room for upside till 16,220. However, consolidation in the 15,945 to 16,090 region is the key for setting the course for a vertical rise to the 200 DMA at 17,251. In the week ahead, investors will focus on the likely listing of LIC on the bourses on May 17. India's largest insurance company set its issue price at 949 rupees per share. That apart, primary markets will stay abuzz with Paradeep Phosphates and Ethos initial public offers. Lastly, the last leg of March quarter earnings will see more than 400 companies announcing their quarterly report card this week. Some of the prominent ones include Bharat Forge, Bharti Airtel, DLF, and ITC.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.